Today, the bears are hiding in plain sight. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news with a distinctively Australian flavour. Well, have you noticed every time the stock market takes a little bit of a turn upwards, then everybody claims that the bears were wrong and everything's going to be fine? Well, I for one don't believe that to be the case. And in fact, the Chief Investment Officer at Morgan Stanley Wealth Management, Lisa Shallett, recently published a note highlighting that while stock market investors have been adjusting to the jump in interest rates amid high inflation, they have yet to cope with profit headwinds faced by the S&P 500. She wrote, while a rate peak may solidify estimates for the equity risk premium and valuation multiples, equity investors still face the bear market's second act. They have been slow to recognise that pricing power and operating margins, which hit all-time highs in the past 2 years, are unsustainable, she said. Even without a recession, the mean reversion of profits into 2023 translates to a 10 to 15% decline from current estimates. In fact, it was the unprecedented monetary and fiscal stimulus during the throes of the pandemic that led to the largest US companies booking record operating margins that were 150 to 200 basis points above norms seen in the past decade, according to Shallett. She said that company profits may now be imperiled by slowing growth, with demand skewing towards services after pulling forward towards goods earlier in the pandemic, and a likely reversal in extremely strong pricing power as the Fed fights surging inflation with interest rate hikes. Such risks are not discounted in 2023 consensus yet, constituting a material risk to stocks for the remainder of the year, Shallett said. While many sectors have discounted the potential drop in 2023 profits from current estimates that could stir headwinds even with no recession, the mega-cap secular growth stocks that dominate market cap indices have not, she warned. And those indices are where risks get repriced in the bear market's final stages. And Morgan Stanley's chief US equity strategist, Mike Wilson, estimates as much as 11% downside from consensus estimates, with his base case earnings per share forecasts for the S&P 500 for 2023 being $212, according to Shallett's note. And meanwhile, as investors capitulate to higher inflation, peak policy rates moved up aggressively in the Fed funds future rates, with the terminal rate now at around 5%. That's an aggressive stance that smacks of peak hawkishness, according to the Morgan Stanley note. Critically, although the market is still pricing 1.5 cuts in 2023, the January 2024 Fed funds rate is estimated at 4.5%, a comfortable 100 basis points above our forecast for core inflation, measured by the Consumer Price Index, Shallett wrote. Consider locking in solid short-term yields in bonds and shoring up positions in high-growth dividend-paying stocks, she said. Short-duration treasuries look attractive, especially because the yield is more than 2.5 times that of the dividend yield on the S&P 500. And elsewhere, in an opinion piece for MarketWatch titled "Stocks Are Rallying Now, but the 9 painful stages of this bear market are not even halfway done," author Michael Sincere highlighted that the official definition of a bear market is a 20% or greater decline from an index's previous high. Accordingly, the 3 major US stock market benchmarks, the Nasdaq, the S&P 500 and the Dow Jones, are currently all in a bear market. And he said, based on his work with stock market strategist Mark D. Cook, a typical bear market goes through 9 stages. Right now, we are in stage 4. And he said, keep in mind, though, that a bear market does not always follow these stages in the exact order. But the first stage, which he called failed rallies, represents the first clue that a bear market is here. Failed rallies often appear before the market officially becomes a bear market. If the rally doesn't have legs and cannot go higher for the next few days or weeks, it confirms that the bear's claws have sunk in. And along the way, many failed rallies will fool bulls into thinking the worst is over. Watch the rallies for bear market clues. The rally so far this week is an example. Now in its second day, a failure of this rally would confirm that stocks are not yet out of a bear market. The second signal to look for is low volume rallies. Another bear market clue is that stocks move higher on low volumes. This is a clue the major financial institutions aren't buying, although algos and hedge funds might be. It's easy for the algos to push prices higher in a low volume environment, one of the reasons for monster rallies that go nowhere the following day, those one-day wonders. Thirdly, then there are terrible looking charts. The easiest way to identify a bear market is by looking at a stock chart. It goes without saying that the charts look dreadful, both the daily and the weekly. While rallies help relieve some of the pressure, they typically don't last long. And then step 4 is strong sell-offs. It's been a couple of years since markets have experienced extremely strong sell-offs, but that record was broken the week of September the 26th, when the S&P 500 hit a new low for 2022. These strong sell-offs are typical of a bear market, followed by rallies that don't last, a roller coaster that so far has played out during October. Fifth, mutual fund redemptions. During this stage, after looking at their quarterly and monthly statements, horrified investors throw in the towel and sell their mutual funds. Also, some investors refuse to look at those reports. As a result, mutual fund companies are forced to sell, which negatively affects the stock market. And typically, when the indices fall by more than 20%, mutual fund redemptions increase. Sixth, complacently turns to panic as more investors' money leaves the market. Many investors panic. The most bullish investors are holding on for dear life but are buying fewer stocks. The most nervous investors sell to avoid risking precious gains. Seventh, all news is bad news. As the bear market pushes stock prices lower, it seems as if most economic data and financial news is negative. Many people become skeptical of the bullish predictions from market professionals who earlier had promised the market would keep going up. In the depths of the worst bear market, some bullish professionals are jeered or ignored. Even die-hard bulls are increasingly nervous as the market heads lower and lower, with occasional rallies along the way. And then eighth, bulls throw in the towel as trading volumes decrease on down days, and some investors experience 30% or greater losses. They give up hope and sell. The market turns into a free-for-all, as even the Fed appears to have lost control, and many in the media admit that a bear market has arrived. And ninth, capitulation. After weeks and months of sell-offs and occasional rallies, many investors are panicked. Investors realize that it may take years before their portfolios will return to break-even, and some stocks never will. In the final stage of a bear market, trading volume is more than 3 times higher than normal. Even some of the true believers liquidate positions, as many portfolios are down by 40 or 50% or more. Almost every financial asset has fallen, with the exception of fixed incomes such as CDs and T-bills. Traders or investors who trade on margins feel the pain. So, if he's right, this bear market is fairly young, but already there have been so many failed rallies that many investors are too afraid to buy. Some investors with cash are looking for bargains, but it takes nerves of steel to buy when everyone is selling. But one of the keys to success in the market is to buy what people don't want. And so he suggested several ideas as to what to do. And it's, he said, not too late to act. During bear markets, a key to survival is diversification. If you're patient and are willing to hold positions for years, dollar cost average into index funds on the way down. In the early stages of a bear market, consider moving to the sidelines with CDs or treasury bills. And consider building a strong cash position, although inflation will cut into some of those gains. Nevertheless, losing to inflation is better than losing 30% in the stock market. The goal is not to lose money. In a bear market, cash is king. The length and volatility of every bear market is different. No one can predict now how this one will turn out, but based on previous bear markets, he says there's still a long way to go before it's all over. And I have to say, I agree. We are yet to see more than the foothills of this bear market come to fruition. So anybody who's claiming that this is the end and it's all uphill from here, I think is missing the point. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.